I'm Jeni Brown. Welcome to this week's MFB News. I hope you're all really well. How's the weather where you are? I've been hearing reports. It was great actually yesterday on Tuesday. I was speaking to various people dotted around the country and getting their snow updates. In Sevenoaks, we just had freezing cold rain. It was like the most miserable day in terms of the weather. So for those of you who are having snow, I hope you're having fun in it. And for the rest of us who are just like in freezing cold rain, wrap up warm. I don't think it's going to get any better anytime soon. Now, in terms of what we got for you today, we're going to do our usual update on what's been going on with swap rates and lender pricing changes. And then we're going to take a good look at the north-south divide and why so many landlords have switched their investment strategy to investing into the north of the country rather than the south. Okay, so in terms of swap rates, no real changes there, I'm afraid. So 2-year swap rates, 4.2%. 1 month ago, they were at 3.98, so they've increased by circa 0.2% month on month. 5-year swaps are at 4%, or just slightly over. 1 month ago at 3.75%. So we can see that things are higher month on month. The good news is they haven't got dramatically worse since last week, and dare I say it, they're slightly lower. In terms of how this is shaken out with lender pricing, we've seen basically a raft of people repricing upwards again. So Kensington have gone up by 0.3, as have Bank of Ireland, TSB Precise and Accord by 3.5, and Vida Home Loans, by 0.35, and Vida Home Loans by 0.4%. Now, interestingly, there have been a couple of lenders who have brought their rates down. So we've seen Landlords bring rates down by 0.2% on some of their products, and Fleet by 0.15 on their 5-year fixed rate. So not all doom and gloom. Why are these guys pricing down when everyone else is pricing upwards? I think it's a kind of combination of timing and how far they priced upwards in the first place. So some lenders are increasing their rates who maybe didn't reprice already. So these guys are just a bit slow to the party essentially. And I think with Landlords and Fleet, probably what's happened is they repriced at a point where they had to kind of put rates at a certain level because of their cost of funds, and then things have moved around. Maybe they kind of put a bit too much margin on just to kind of hedge their position, so they're able to kind of loosen things off a little bit. So in terms of where this leaves us and really how things are looking going forward, so one of the things I'm being asked all the time at the moment is, okay, so interest rates have gone up a bit, when do we think they're going to come down? And the reality is, for me, I can't see anything happening this side of Christmas. And the reason for that is that when we look at all the news is kind of in the ether. So we've just literally, as I'm talking to you, the inflation data is coming out, and inflation has ticked up slightly because of energy costs. So it's at 2.3. We've got the news about wage inflation, incredibly sticky. We've got the news about Trump putting a 10% tariff on things, which could have a knock-on impact as the kind of things are escalating again with Ukraine. You know, there's all this stuff going on. So the markets are going to be very nervous. So I genuinely don't think we're going to see rates come down this side of Christmas. I would like to be wrong. I really would. But I just can't see it happening. I can't see any reason why the Bank of England are now going to change their, or kind of the market's going to change their plans or expectations of what Bank of England is going to do with base rate over the next 2, 3, 5 years, because there's nothing that's sort of come out that would give them any cause to do so. So I think the reality is, guys, that things are where they are in terms of interest rates. The good news is, and I'm having this conversation with people, and I do bang on about this often, but because it's such a useful thing to be able to do. What I'm saying to my clients is, look, you can book a rate now, apply for a mortgage, you can take a rate. The good news is that if the lender puts their rates up, you're not going to have to take a higher interest rate. You've kind of got the worst case scenario. But if before completion, and for some people this can be 5-6 months away, and a lot can change during that time, if rates do come down, most lenders will let you move onto the new lower interest rate. Some will charge you a small admin fee. When I did my mortgage, I made use of this kind of facility. They charged me 150 quid. It was really worth paying because of the amount I'd save in the long run. Some lenders do it for absolutely nothing. So, you know, you can still apply for a mortgage now, get a worst case scenario in case, you know, things go totally skew-if again. But know that actually by the time you complete, if rates have come down, you could still benefit from that. So I think more another few weeks of watch this space in terms of interest rates. Let's see what happens. But like I said, I can't see much changing between now and the end of the year. Now, Paragon have released a fascinating report with regards to the north-south kind of investment patterns and how things have kind of moved over a 10-year period, which I found really, really interesting. So I'm going to be quoting a lot here from this wonderful report. But I think as investors, it's always interesting, first of all, to see what other people are up to. It's also interesting to understand their logic. And also there are still, despite everything that's going on, lots of you who are still planning on investing and growing your portfolios because this is your job and this is what you do. And so, you know, people are sort of thinking about, well, okay, if I'm going to invest next, where do I invest? So this might be interesting, particularly to you guys. And obviously the people in the north are just going to love this because it kind of reinforces their investment decisions. So look, the geographical shift in buy-to-let investment, according to Paragon's analysis of industry data, highlights how 10 years ago, London and the southeast of England were the regions where the highest proportion of buy-to-let mortgages were written for property purchases. So this is based on Paragon's own lending data. This isn't the whole market, but as such a large professional lender, we can kind of assume that Paragon will be representative of the market as a whole. So by the end of 2023, the regional market share had shifted as landlords in the north became the most active investors in buy-to-let property, while the proportion of buy-to-let mortgages written to landlords in London and the South East had dropped. So why is this? So first of all, Paragon kind of nod to tax policy changes. So since the stamp duty surcharge was introduced, South East London, Greater London and the South West purchases were at 53% but dropped down 17% to 35%. So 10 years ago, 53% of the mortgage applications that Paragon were underwriting were South East London, Greater London and the South West. This has dropped down by 17% to 35%. And the kind of school of thought here is that this is because as house prices tend to be lower the further north that you go, investors have been, and that's generally speaking, by the way, investors have been attracted to those areas because of lower stamp duty costs associated with the lowest purchase prices. Now, in addition, they think about affordability. So the flip side to higher property prices in the south is, of course, generally greater affordability of property in the north. So the Office of National Statistics Housing Affordability Ratios calculates affordability ratios by dividing house prices by gross annual workplace-based earnings. So on average, homes purchased during 2023 in England commanded 8.3 times a full-time employee's annual salary. The latest release reveals that the most affordable areas in 23 were the North West, North East and Yorkshire and the Humber. Now across these three regions, there are only 4 local authorities with ratios higher than 8. Burnley and nearby Hindburn, both in the northwest, were 2023's most affordable local authorities with ratios below 4, so less than 4 times the average income, as it were, to buy a property. The North East was the most affordable region overall, with more local authorities with affordability ratios below 5 than above. London was the least affordable region, boasting 82% of local authorities with affordability ratios above 12. It's unsurprising then that the least affordable local authority can be found in England's capital. Can you guys guess which one it is? Kensington and Chelsea. The average property was purchased for 34.3 times the average gross annual salary. So as we can see here, in terms of property prices, and there is a kind of knock-on impact in terms of property prices and rent, you know, actually the reality is that the north of England is much more affordable than the south, and sometimes many times over. Now, another reason that people are moving their attentions to the north is the yields. So the relative affordability of property in northern regions is a central component of the strong returns that landlords can achieve on their buy-to-let investments. So analysis of Paragon's own lending data shows that the highest rental yields come in at the northeast of England at 8.13%, Wales at 8.07% and the northwest at 7.84%. So yields are very strong in those areas. Now, in addition to paying less tax when you buy a property, your yield's been better. Another thing is demand for rental properties in these regions. So high tenant demand across the north, which has been driven by industry, universities and flexible workforces, creates an attractive buy-to-let market. Although the second half of 2024 has seen a slight improvement in the supply of homes to let, tenant demand, which hits record highs during 2023, remains elevated in all regions across the UK. But in the north of England, the highest levels of overall tenant demand can be found in the northwest, where 81% of landlords currently report a strong demand for their rental properties, and this is followed by Yorkshire and the Humber and North East. So all of these areas are experiencing really high demand for rental properties. Now, if we just break that down a bit further, and look at why there is such high demand. So if we look at employment, so first of all, the PRS, as we know, houses a diverse population of people throughout the UK ranging from families with children to older couples. And we also see demand concentrated where the market exists to serve specific sectors and industries. So the automotive and broader manufacturing industries are both examples of prominent employers in the north of England. And these guys are often reliant on flexible staff to enable them to respond to market changes. So rented homes are well suited to these workforces as they benefit from greater flexibility compared to the owner-occupied property market. So essentially what we're saying here is that actually because of some of the kind of stronger levels of sectors of employment in the north of the country, actually this kind of supports the requirement for having a lot of rental properties available. Now, in addition to working people's demand, student demand is also very, very high in the north of England. Similarly, rented homes are often preferred by students because short-term tenancies can be aligned to course durations. Now, according to the Higher Education Statistics Agency, 632,110 students enrolled into higher education courses in the north of England during the 2022-2023 academic year, providing a sizable market for buy-to-let landlords. So essentially what we can see here is that actually there's a genuine reason why there's such a strong demand for rental properties in the north of the UK or England as well. So just to kind of summarise really and give you some high level numbers. So breaking it down across the north, which as we can kind of see broadly encapsulates three areas: the northeast, northwest and Yorkshire and the Humber. So the northeast, the average yield there is 8.13%. The proportion of landlords reporting strong demand, 68%. The proportion of landlords reporting making a profit from their buy-to-lets, 83%. If we go across the Pennines to the northwest, the average yield, 7.84%. The proportion of landlords reporting strong demand, 81%. The proportion of landlords who report making a profit, 78%. And then lastly, Yorkshire and the Humber, average yield, 7.54%. Percentage of landlords reporting strong demand, 78%. And proportion of landlords who report making a profit, 83%. So I think really just kind of looking at that, what we can see is that there's a real case for why, first of all, the demand has shifted, so there are more landlords investing in the north of the country, and secondly, why that is. So I hope that just is kind of insightful, I suppose, to see, first of all, why there's such a shift in trend over the last 10 years in terms of investment, but also maybe give you some food for thought if you are thinking about investing in the next few weeks, months, years, why the north may be worth considering if you weren't thinking about it previously. Now, that's not to say that the south of the country is without need for rental properties isn't a great place to invest, but I think it's always just worth kind of keeping in mind that sometimes thinking a little bit further afield could be something worth doing. And that's actually it for this week. Sorry it's a bit light on the old mortgage side of things. There really hasn't been that much to report. I think the market is kind of just sitting and watching and waiting at the moment. So first of all, the interest rates and also criteria changes, I think it's kind of just a wait and see period of time. In terms of the kinds of stuff we're seeing, so we've got lots of clients who are remortgaging. As I mentioned at the start of the video, people are certainly booking rates now and then kind of hoping that rates will come down before completion, essentially. We're definitely still seeing people buying properties. A few people have said to me, oh, I bet, no one's buying properties anymore because of the stamp duty changes. No, actually, people are continuing to grow their portfolios. For those people whose business is buy-to-let and they want to grow their portfolios, they're just going to kind of factor those costs in when they're assessing the kind of commercials of buying a new property and decide whether it's worth it. And actually the numbers are still working out for people, so definitely seeing some purchase business. And actually, dare I say, it's actually increased since the autumn statement. There you go. So as always, if you have any questions to discuss anything that we've talked about today, or mortgages more broadly, we'd love to hear from you. 0345 345 6788. Keep warm, guys. It is absolutely freezing. I'm just looking out the window and going to get my my big scarf and my big coat out, I think, for today, and maybe even my heated gloves. Maybe I'll tell you about those next week. Look after yourselves and I'll see you next time.